Today, I want to talk a little bit about refinance options. So, if you got your loan a couple of years ago, or now it's a little longer than that now, but 2020, 2021, even parts of 2022, when rates were fairly low or very low in comparison to where things are at these days, you have this first mortgage with this super low interest rate. And if you are to refinance that first mortgage, you're not going to have that super low interest rate anymore. So, what options do you have besides a full refinance that might make sense for you? Those options tend to be second mortgages. So, second mortgages, you generally have two different options. You have a lump sum type of second mortgage where you're getting all of the money up front, and you have a line of credit, a home equity line of credit type of second mortgage. And that works a little more like a credit card. So first I'm going to get into the lump sum second mortgage. Now, each lender can offer these a little bit differently, but from what I've seen, a lot of times these are fixed rate mortgages and you get all of the money up front. You're making principal and interest payments throughout your term, and they're attached to the home in second position. The second option is going to be a home equity line of credit. From what I've seen, these are normally variable interest rate loans, meaning they do have the potential to adjust. That interest rate has the potential to adjust actually quarterly and is based off of the prime rate. Additionally, a lot of times these home equity line of credits are interest only payments. So unless you're actively making payments towards that outstanding principal balance, it is not going anywhere. It's not going down even a little bit because those payments that you're making every month are interest only. Now, each of these types of loans has advantages and disadvantages. Sometimes people hear variable interest rate or home equity line of credit, and they think of all these, they get a little nervous because there have been some poor uses of these loans, but they're just tools. And so as long as the tool is working towards your mortgage strategy, they can both be beneficial. So something that a second mortgage might be good for, that lump sum option, are situations where you need all of the money up front and right away. So, for example, if you're trying to consolidate debt, or if you are needing to pay for a child's college, something like that, where you are going to use all the money right away, those second mortgages are great for that. They're also great if rates are going up, and you know that you're going to use all the money within a relatively short amount of time. A second mortgage might be the way you want to go. Now, home equity lines of credit, those are going to be really great for things like if you are doing renovations. So let me explain a little bit more about how these loans work. So you're making those interest-only payments, but what can be nice about these second mortgages that are home equity lines of credit is that you're only paying interest on what you've pulled out so far. So if you have a line of credit, a $100,000 line of credit against your home, and you've only used $20,000, then you're only paying interest on that $20,000. So it's great if you're doing like home repairs. So let's say you're doing a bathroom repair and you only need the $20,000 for the bathroom repair. Theoretically, you can do that bathroom repair, and if you're choosing to make more than the minimum payment, you can pay that down to zero and still have the full $100,000 available to you. So renovations, a lot of times a home equity line of credit is really great for that, especially if your intention is to sell within a certain amount of time. If you're doing the renovations in order to sell in a year or two, a home equity line of credit is really probably the way to go. Another great use of home equity lines of credit are emergency funds, or quick access to your equity. So if you're an investor and want to be able to access the equity in your home, either for a down payment or to purchase something relatively quickly, having a home equity line of credit available is great. By the same token, if you're an investor and you have rental properties, having a home equity line of credit to be used in case you need quick access to funds for repairs is also a great option. And then if you just have that home equity line of credit in case. So in case you have a medical emergency or a medical issue where you're going to need to have access to the equity in your home to pay for things, just as kind of a safety net, not something that you're necessarily going to use, because again, you're not being charged interest against the funds if you don't end up pulling them out. So both lump sum second mortgages and home equity lines of credit are great options if you don't want to touch your first mortgage. They generally have lower, if any, closing costs, and they also tend to be a little bit quicker of a process. All right, if you have any questions, let me know, drop them in the comments or DM me, and I will see you next time.